Joining me next is Omri Thomas. Omri is the portfolio manager of the Nedgroup Investments Opportunity Fund. The Opportunity Fund utilizes a broad toolkit of asset classes and strategies to deliver its inflation-beating performance objective over the long term, while aiming to protect capital over rolling 2-year periods. Hi Omri, thanks so much for joining us today.
Hi Natalie, it's nice to be here.
Yeah, it's great to have you.
Thank you.
So I'll start by saying the performance of the fund is truly noteworthy. Despite the fact that the mandate caps equities at 60%, it still managed to deliver over its inflation target of 5%. So this achievement with this lower allocation to risk assets is truly commendable. So, this focus on real returns coupled with capital protection is so well demonstrated in this fund. So maybe we can just start with you talking us through the performance for the year. Sure. And what contributed and detracted over the period.
Thanks, Natalie, and thanks for your kind words. I think we in the multi-asset space, you're in the fortunate position that you've got a lot of tools at your disposal. You've got a multitude of asset classes available, and I think specifically in opportunity, I think we make use of unique assets. So we like to look for asymmetric return type of instruments where you try and limit the downside and participate in the upside. If I go back 3-4 years ago, it was a very tough environment to get returns. A lot of your asset classes were extremely overvalued. You look at the developed market bonds, specifically the US market at the time looked expensive and it just kept on railing, so that did well. And the rest of the world also looked expensive, especially the fixed interest markets. So it was difficult to structure a well-diversified portfolio to achieve inflation plus returns. I think if I go back a year or two ago, that situation's now changed, and there was a lot of opportunities that you could capture alpha. So specifically last year, what helped the fund, we had a very constructive view on South African bonds. We had a long duration and we're quite a heavy weighting in bonds, and we also filtered our equity exposure to domestic SA exposure, and both those contributed handsomely to returns. So most of it came through from those two asset classes.
Okay, so SA equities was one of your largest contributors to returns. What could we expect to see next year? I mean, we've just had a year where maybe people felt it was the start of something new in South Africa, and there's been a lot of positivity and optimism. But our Q3 GDP print was negative. Yeah. If we see another negative print, then we're heading into a technical recession. So how does that bode for consumer confidence in 2025?
Yeah, it's interesting. So the market's a discounting mechanism. So normally the market's forward-looking, and market sentiment has definitely improved. If you look at business confidence at a multi-year high at the moment. So the consumers and businesses with a new stable political environment have become a lot more confident about the outlook, the earnings outlook, their ability to spend capital and to spend capex, to not hoard cash on the balance sheet, to bring back cash that was offshore back onto the into the local market and reinvest in the business. So the business confidence is improved. We've moved from a lot of load shedding to zero. Now there could be a few more days of load shedding, but I think we through the worst. You've had Transnet, and it's a sort of a long cycle industry, like electricity, which has been a big negative drag on economic growth. And I think we're getting close to the bottom as well. So that negative drag maybe doesn't disappear, but I think it will soften and actually start improving in time. You've got interest rates that have been cut, and probably expectations of maybe another cut or two, which will be positive for the markets. And then you've had the two-pot system, a lot of cash flowing into consumers' pockets, and interestingly, some of it being used to reduce debt, but also some of it used in consumption. You've had petrol prices coming lower, which has been another boost for the consumer. And then at a macro level, there's a good chance that through the next 12 to 18 months, we could be removed from the grey list. And I think that will attract capital flows back into South Africa, which is, I think we've moved from, as you've rightly said, we've moved into sort of a negative GDP growth period. And I think the outlook is for not great growth, but better growth that we've been achieved. So a lot of positive factors and confidence improving, boding well for company earnings. Now, we've seen a lot of these companies re-rate, but it's come from a very low basis. So now you've got earnings maybe improving and further chance for re-rating, which keeps us positive on South African equity specifically.
So lots to look out for this year, certainly.
Hopefully.
So let's chat about the US then.
Yes.
A 1.9% gain. That's what Wall Street strategists were predicting that the S&P would do in 2024. And JP Morgan actually had one of the most bearish estimates. They said lackluster earnings growth, rising geopolitical risks, and softening economic demand. And they were actually predicting losses for the S&P.
Sure. Yeah.
Then you combine that with the year of elections, where people say, stocks traditionally do quite badly. But by the end of March, the S&P had surpassed most of the analysts' predictions, and it actually ended the year up 25%.
Yeah.
So the whole year, it seemed like everyone was watching this market saying, it can't keep going, it's so expensive, but it just kept running. Yeah, what can we expect to see next?
Yeah, it's interesting. In fact, I think it beat the most bullish forecast out there from all the analysts.
It did.
And so the market just kept on climbing this wall of worry. Now, it was quite concentrated in a few stocks, and they had a big index weighting. So if you look at the average weighted index, the market didn't do that well. But the US market, especially if you compare the S&P earnings yield to the US bond yields, that spread has now gone negative. That's normally not a great time to be investing in the markets. That's normally a predictor that you're getting close to the top of the markets, or that your near-term returns from the markets could be a lot lower. So I think the markets were very optimistic about rate cuts and continued support for valuations on the back of declining interest rates. I think that scenario has changed now, where expectations of the number of cuts have reduced significantly. So I think it's a much more balanced outlook now. I think valuations look expensive. There's a lot of hype in specifically AI tech stocks. Those companies are trading at eye-watering valuations. It's always very difficult to call the tops on a market where there's so much positive sentiment. But what we have seen, once sentiment turns and there's a focus on earnings, suddenly you can see big drops in it. And it's happened in the tech sector. I think it was 22, where the NASDAQ was down, or the big tech stocks were down 30, 40, 50%. So for me, I'm cautious on US equities, whereas on US bonds, we've seen a significant sell-off in US bonds. Bond yields now offering you decent real returns relative to inflation. So we've become more constructive on US bonds, where we had a zero holding previously.
Okay. So compared to the US, China valuations are actually looking very attractive now.
Yeah.
And I know you have some Chinese holdings in the fund, so you are quite positive despite the risks around it. So can you just talk us through your views on the Chinese market?
So, yeah, it's interesting. Everyone's quite negative on China, but if you look at the Chinese market, last year it didn't actually perform that badly. I think it was the second best performing market after the US. So it didn't feel like it, because it felt like China still did badly. But remember, there was quite a strong rally in the second half of last year. It beat it out a bit, but despite that, Chinese shares still look extremely attractive. If you look at the Chinese index, the MSCI China versus the MSCI All Country World Index, it's still at a multi-year low. And it's back to its levels where it was sort of the start of the century. Now, if you look at China, they've got a trade surplus of $1 trillion a year. So I'm going to think of a company, when a company's got such strong cash flows, what do they do with it? They can do share buybacks. And to some extent, that is what you see in China at the macro level. The Chinese is doing a lot of fiscal stimulus by pushing that money back into the market. So they've been cautious on not overdoing it and creating bubbles. But at the same time, you've got the companies who's also cash flush, and they've now started buying back shares, and that's at valuations 70-80% lower than they were previously. So China's still growing. I think if you're willing to see through the short-term geopolitical tension between China and the US, you could be picking up shares giving you multiple returns from current levels at very attractive valuations.
So what other asset classes are you seeing value in at the moment? What else do you think is attractive?
Yeah, I think.
Also, how are you putting it together in terms of the portfolio positioning?
Yeah, I think it's a good question. Again, I think in South Africa we are in a privileged position that a lot of our asset classes offer you positive real returns at the moment. So you can actually construct a well-diversified portfolio that can give you inflation-beating returns over the long term. So what we like is SA equity, as I referred to. We think that rand's actually oversold. We've actually hedged quite a bit of our currency, our FX exposure back into rands to protect against the strengthening rand. Remember, if you've got 45% offshore, that is a big bet on one macro event of the rand continuing to weaken. And we don't think the rand's a one-way bet from this level, given our more constructive view on economic growth. And we've still, despite the spread narrowing, we've still got a positive spread relative to developed markets. We think China, as I said, look attractive. US cash and US bonds have moved from expensive bucket 2 years ago into the attractive bucket. What we still think is expensive is US equities. Developed market bonds, we still see risk there. And developed market equities outside the US, we think is fairly valid. So enough tools for us to construct a well-yielding portfolio.
And I think there will be good things to come for the fund in 2025, I'm sure.
We would hope so.
Thanks so much, Omri. We really appreciate your insights and your time today.
Thanks, Natalie.